conventional loan. A conventional loan has a minimum down payment of 3% to 5%. What is the difference? The 3% is for first-time home buyers, good credit. So if you have a first-time home buyer with a 780 credit score, a 760 credit score, I would take them to a conventional loan with 3% down. That would be the cheapest loan I can afford them. Now, everybody else most likely will get a 5%. Okay, on conventional.
Right?
Yeah, it's most common, 5%, because of credit score, because it's not the first time they're buying, yada, yada, yada. But 3 to 5, that's conventional. FHA, 3.5%. VA, $0. USDA, $0. Now, we don't have a lot of USDA here because we're densely populated, but if you go out to Ocala and those places where it's rural, then we can do USDA 100% financing, great loan product. So now we have a little example there, $400,000 home on a conventional loan, 3% down is $12,000. That same house with FHA is $14,000, VA is 0, USDA is 0. Those are your down payment requirements, and those are the loans that we do the most. There are other types of loans that we do, but this is the majority of the people that we serve, which is first-time home buyers.
And during our buyer consultation, we could just go over these examples and let them know here's the type of loans that are out there.
Mhm.
Other than that, we do not discuss anything further. We just, have them speak with Kelly.
Yeah,
or
I'll have the talk, but it's good for you, because they're gonna ask.
Yeah.
But it's good for you guys to know. There are two insurances that you're gonna have. You're gonna have your homeowner's insurance, your property insurance for hurricane, fire, flood, theft, all this that protects this piece of home, right? And when you finance a home, the lender may require you to have mortgage insurance. So with FHA is MI, mortgage insurance. With conventional is PMI, which is private mortgage insurance. What is the difference? Conventional loans are insured by private companies, right? So an insurance company is going to insure this loan to the lender in case I bought a house, I put 3% down with conventional. Because I'm only putting 3% down, the lender needs an insurance policy, because if I stop paying, they are in big trouble, they lose money. What they do is they get an insurance policy that I pay for, and that insurance policy protects them, the lender, in case I default on my mortgage. So that insurance policy is gonna pay 20-30% of the house to the lender, so the lender doesn't lose money if I foreclose. That is private mortgage insurance. Now with FHA, FHA is a government agency. HUD is a government agency, right? HUD has mortgage insurance requirements. With FHA, you are required to keep the mortgage insurance for the life of the loan. For as long as you have an FHA loan, you have to pay mortgage insurance. The government is going to collect 1.75% of your purchase price and put it in this insurance bucket where they put everybody's money there. And then FHA is going to insure all of the loans that they give out. FHA, the government agency, works like an insurance agent for the housing market. For lenders who are lending under FHA guidelines, they are going to insure those lenders. You're not going to lose money, because we have this pool of money over here, sitting here. And if you lend this person with a 580 credit score, $400,000, and they don't pay, we're going to pay you. So that is DMI, that is how it works, and that is why FHA rates can be better than conventional, but it's more expensive because the buyer is paying a monthly mortgage insurance plus 1.75% of loan amount, so they can pull that money away and have money in case of default.
And make sure closing costs go up too.
Yes, so FHA is a great product, but it's more expensive than conventional depending on the client credit score. And sometimes that's why I advise people to take a conventional loan if they have a 780 credit score than an FHA loan, even though the rate with FHA is going to be better. Because at the end of the day, it's cheaper for the client.
When they're pre-approved and we're going to make an offer, we're writing up the offer, we're always going to consult with Kelly first. So, okay, you love this house, that's great. We're looking up comps. Okay, we think we wanna offer this price. Okay, great. I always pay Kelly and I put everybody on the email. Kelly, here's the house. I always send her the house so she could see what the taxes are looking like, if there's an HOA. So she's gonna prepare a fee sheet based on the offer price we want, and then we're gonna tell her how much money, she's gonna have a conversation with them. What are you kind of thinking here? And this will be up front anyway. She's gonna know.
Before you go on the contract.
Yeah. With their pre-approval, we're gonna know, okay, they have 5, 10, sometimes people wanna put 20%, it just depends, down. And, then she's gonna provide these 2 fee sheets, I always give her, give me 2 options, just so they can see it. And then with the 2 options, what I always ask is, I ask her, give me one with seller credit, so we can either put it towards the closing cost, or even better, we're gonna use the credit to buy down the rate, just depending on what the rates are looking like, okay? And in our contract, it's just gonna be a seller credit. At that point, we don't need to say what it's actually for, it's just a seller credit, okay? And then later on, when we get in a contract, Kelly can have that conversation, because they're gonna have a fee sheet that says, okay, this is going towards, let's just say $10,000 going towards your closing cost, or put it to reduce the interest rate. And at that point, once we get into contract, our clients will confer with Kelly what best works for them. What we're doing is we're securing a seller credit for the buyer in the contract.
Yeah, and then the buyer decides how they wanna use it, but that goes into the loan strategy. The reason why Sabrina knows this is because we have conversations all the time, obviously, with the client's authorization, as to why I approve them for FHA or why I approve them for a conventional loan. So when she's going out there, she knows this is an FHA buyer or this is a conventional buyer. And if it's gonna be conventional, on my end, I see the debt to income ratio. On her end, she sees this house that they want, but the house is outside of their budget. Unless we bind down the interest rate to lower the mortgage payment. So I tell Sabrina, if you can get me $10,000 in seller credit, I can buy this client's rate down by $1.25, which is gonna bring their payment from $4,000 to $3,400, and now they qualify.
And we've had that just in the recent transactions.
These are conversations that we are having all the time.
Oh, yeah.
Because the buyer that is in the market right now, it's tight. Like, a mortgage payment is $4,000. That's a lot of money. That's really big on somebody's financial stability. So we need to be very strategic on how we are placing these people in these houses. And we have to look into a year from now or 2 years from now. Are they gonna be able to afford this? Is there a plan? Are we gonna do a temporary buy down, which we'll go over? And then in a year from now, this is the plan. Or there are many ways to do this, but we have to be very strategic on how we're gonna do these deals, how we're gonna get them to qualify, and then what's the plan moving ahead. Because this is not one transaction and you never see these people again. These are long-time clients. I'm closing a client that I first worked with him in 2018 when he bought it, then I refinanced him, and now he's buying his second home. And we have a relationship, a business relationship, and you will continue to have a business relationship with these people. So we have to do right by them. So that is one way that it works. That's why we can do deals that other people cannot do, because we are looking at everything. And we are providing these people solutions for their living situation, but also for their financial situation after they sign the paper and they get the keys.